Welcome to Inside the Economist's Mind, where we dissect the forces shaping global trade and commodity markets. This week, we dive into the Resources and Energy Quarterly, September 2025 edition. The headline forecast reveals that Australian resource and energy export earnings are projected to decline by 5%, falling from $385 billion in 2024-25 to $369 billion in 2025-26. But look closer, and you'll find a story of profound internal market shifts driven by macroeconomic uncertainty and the accelerating global energy transition. So that 5% decline, it feels almost like just the wrapping paper, doesn't it? Our mission today is really to tear that off and show you the radical substitution story that's happening underneath. We're tracking the winners and losers in global commodities, and they're being driven by these huge macro risks, and maybe more importantly, the sheer speed of the energy transition. It's really restructuring trade.
Absolutely. And it's critical to note, as you said, that the total forecast number, it looks largely stable compared to the June REQ, which, could easily lull you into a false sense of security. But the real insight here is that lower commodity prices are actually more than offsetting some significantly higher export volumes. That's across the outlook period, so through 2027. The sectors that, underpin trade just a few years back, they're ceding ground, and quite rapidly, to a whole new generation of exports.
Okay, let's start with that big picture then. We always seem to be talking about uncertainty, but the IMF seems to have found maybe a little patch of blue sky. They've nudged the 2025 world growth forecast up slightly from 2.8% to 3.0%. Is this, cautious optimism, or is there something more solid there?
It's more stabilization, I'd say. And it's definitely supported by central banks globally, kind of moving away from that aggressive tightening we saw. They're shifting towards a more neutral, maybe even slightly stimulatory monetary stance. And that policy shift, it's generally helpful for overall demand. However, and there's a big however, that stabilization comes with two really visible anchors dragging on it. Those are the persistent increases we're seeing in trade barriers and, of course, ongoing geopolitical tensions.
Tell us a bit more about those trade barriers. It sounds like the U.S. tariff hikes, they're not just theoretical worries anymore. They're actually being modeled as economic constraints now.
Precisely, yes. The U.S. tariff increases, they are expected to noticeably detract from U.S. economic growth and at the same time add to their inflation. We expect this drag to become, most apparent probably in the second half of 2025 and then extending well into 2026. That creates a kind of market friction that's definitely going to affect commodity flows globally.
Right. So if stabilization is the macro story, the micro picture seems to be all about high-level policy intervention. We definitely need to talk about China's anti-involution measures. That's a fascinating term, if maybe a bit dense. What does it actually mean?
Yeah, it sounds academic, doesn't it? But think of anti-involution simply as China's economic quality control mechanism. That's maybe the easiest way. It basically involves central government action to cut, or at least cap, excess capacity in manufacturing and also in metal refining. The policy has this dual aim, and it's highly strategic. First, avoid the trade friction that comes when you flood global markets with, cheap exports. And second, improve domestic industrial margins and energy efficiency. It's really a calculated shift, quality output over just sheer volume.
Okay, that makes sense. So that policy push, combined with these shifting monetary expectations we talked about, that brings us to the currency forecast. The Australian dollar, the AUD, is expected to rise against the US dollar over this outlook period. How does that policy expectation translate into dollars and cents for our resource exporters?
Well, the consensus expectation is that the U.S. will likely enact deeper and probably faster interest rate declines compared to Australia.
Yeah.
So this makes AUD interest-bearing assets relatively more attractive to investors, which naturally boosts the currency. And while, a stronger AUD is great if you're an Australian consumer buying imports,
Sure.
for exporters, this appreciation immediately translates into squeezed margins. It's quite direct. Think about it. An Australian miner sells their iron ore, say, at a fixed US dollar price. But when that revenue gets converted back into Australian dollars,
They get less.
they get less. It directly weighs down those total export earnings when you express them in AUD terms.
Right. Okay, so let's transition now from that macro strategy view to the market casualties. If we look at the sectors really feeling the pain from this big shift, LNG seems to be front and center. Earnings there are forecast to drop pretty sharply from $65 billion down to $54 billion in 2025-26, and then even further down to $48 billion the year after. That's huge.
It is huge. That represents a massive $17 billion structural correction, just over 2 years. And the reason, it's rooted in this fundamental mechanism of the, let's call it the legacy market, that is now essentially failing them. It's the oil linkage of those long-term contracts.
Okay, walk us through that mechanism. Why is the price of oil dictating how much Australian gas exporters earn? It seems counterintuitive now.
It does, but historically, many of those big long-term Asian LNG contracts were indexed or tied to oil prices, specifically something called Japan Customs Cleared Crude, or JCC. Now, the forecast we're looking at shows Brent crude prices falling quite sharply from around $70 a barrel this year down towards $59 by 2027.
Okay.
That drop in the oil price feeds directly, almost automatically, into the contract price for LNG sold under those terms. And that happens even if the spot gas prices, the day-to-day prices, don't actually fall as much. So this decline isn't just a price drop for gas. You could argue it's the first major casualty of that oil linkage mechanism really failing in a decarbonizing world.
That raises a really important question then. If we're seeing such a significant structural loss of revenue, how does that affect the long-term investment decisions for Australia's huge gas resources? Does the new supply coming online globally, does that help mitigate this instability, or does it just kind of reinforce the price ceiling?
It really reinforces the ceiling. That's the consensus view. All the new supply coming from major projects, particularly in the U.S. and Qatar, it is expected to curb the extreme price volatility we saw, so it should help stabilize LNG markets, but probably stabilize them after the second half of 2026, and crucially, at a lower price base. So what this means is the market's becoming deeper, yes, but also less prone to those really profitable price spikes that Australia frankly relied on.
Okay. Moving beyond gas then, thermal coal is also set for a gradual decline, falling from $32 billion to $28 billion next year. This feels like the energy transition hitting probably its most exposed fuel source, right?
Exactly. That decline is definitely driven by the global energy transition push.
Yeah.
But also, crucially, by key import nations, think China and India primarily, striving for greater energy self-sufficiency. They're rapidly expanding their own domestic renewable capacity, which just creates a natural ceiling on their appetite for imports.
And metallurgical coal, the stuff that's essential for steelmaking, what's the outlook there?
Met coal exports, they're forecast to be relatively steady, actually, around that $36 to $37 billion mark. But, and it's a significant but, they face significant downward risks. We've already seen a downward revision of about $2 billion for both 2025-26 and 2026-27, just since the June forecast came out. So while it's essential for steel, it's certainly not immune to the volatility and, the policy uncertainty that's impacting the steel sector globally.
Right. So if energy is maybe the major casualty of this transition, where does the foundational commodity iron ore stand in all this?
Iron ore is still the single largest export, but it's forecast to fall slightly, from $116.4 billion down to $113 billion in 2025-26, driven mainly by prices drifting downward. Still accounts for, over a quarter of all resource exports?
Yes, its fate is just intrinsically tied to global steel output, and that's expected to fall by about 1.2% in 2025. This links back directly to what we discussed earlier, China's anti-involution strategy. China's planned output cuts, combined with those trade barriers globally, they suppress demand for imported ore. The benchmark iron ore price, the FOB price, is forecast to decline steadily, reaching an average of about US $81 a ton in 2027.
And this really reflects that changing landscape inside China, doesn't it? Where you've got consolidation of steel production happening and that lingering weakness in their massive property sector. I saw real estate investment drop something like 11.2% year on year in the first half of 2025. All that means moderating iron ore imports for them.
It does. But China's moderation is being, partially mitigated by a really key geographic shift, India. India is forecast to continue pretty robust GDP growth, around 6.4%, and that's fueling massive infrastructure development and therefore steel demand. India is aiming for 300 million tons of steel capacity by 2030, and the expectation is they'll actually become a net importer of iron ore in the longer term.
Okay, that raises a critical question, though. Can India's growth, even though it's robust, can it truly offset the sheer volume that a moderating Chinese economy used to require? Are we maybe witnessing the beginning of a structural ceiling for global iron ore demand overall?
That's the key debate. The sources suggest India provides a necessary, high-growth buffer. but it probably won't fully replace China's peak consumption appetite, certainly not on a volume basis alone. What it does is shift the risk profile. It lengthens the demand horizon for high-quality ore, and it moves the focus away from just maximizing volume toward the quality of ore demanded by newer, more efficient steel plants like those being built in India.
Interesting. Okay, let's pivot then to the growth engines. The clear winners in this report seem to be gold and critical minerals. Gold exports are forecast to rise substantially, up $12 billion to hit $60 billion in 2025-26. Why is gold defying gravity right now?
Yeah, the gold price has been exceptionally strong. It climbed above US $3,800 an ounce back in September 2025. And this performance, it's almost a textbook reaction to three key drivers happening simultaneously. First, you've got the growing prospects of U.S. interest rate cuts. That lowers the opportunity cost of holding gold, which doesn't yield anything. Second, there are these persistent worries about U.S. fiscal health and potential inflation down the track. And third, just sustained safe haven demand, fueled by ongoing geopolitical tensions in the Middle East, Ukraine.
And we can't forget the big institutional players here, the central banks.
Absolutely not. Central bank buying remains a really foundational pillar of demand for gold. They are forecast to purchase around 1,000 tons again in 2025. That provides a massive, quite reliable bid under the market, and it really confirms gold's continuing role as a hedge against sovereign risk and uncertainty.
Okay. Shifting to the industrial side of transition metals, copper. Clearly set for structural demand growth. Prices forecast to rise to an average of US $10,100 a ton by 2027. This isn't just cyclical ups and downs, is it? This feels structural.
Oh, it is absolutely the ultimate structural story right now. We are seeing incredibly strong demand of the energy transition itself. Just as an example, China's massive renewable infrastructure build-out that required 577 kilotons of copper just for the solar capacity they installed in the first 4 months of 2025 alone.
Wow.
And then if you also factor in the surging demand coming from AI data centers, which are expected to account for maybe around 550 kilotons of annual copper demand by 2030, you just see the scale of the required input. It's enormous.
And that scale of demand is hitting the market at precisely the time when we're seeing serious, maybe even amplified supply constraints.
This is exactly why the price outlook is so bullish. That structural demand is simply not being matched by rising supply. Not easily, anyway. We've seen these critical disruptive events like the suspension of Cobre de Panama back in late 2023, the seismic event at Kamoa-Kakula, and more recently, a force majeure declared at Grosberg. These aren't just short-term hiccups. They are significant disruptions that amplify and definitely prolong the copper concentrate shortage we're seeing. It really sets the stage for potentially a long-term supply deficit right in the face of this exponential demand growth.
Is there a consensus in the market then that this deficit is now kind of unavoidable? Or are producers maybe underreporting capacity that could actually come online faster than expected?
I think the general market view is that the deficit is pretty much unavoidable, certainly in the medium term. And that's because these major outages, they represent highly concentrated supply losses. You just can't replace that volume quickly. So even minor delays or slight underperformance in existing mines, they get magnified because of the current fragility of the global supply chain for copper.
Okay, finally, let's look at lithium, often the poster child for volatility in this space. Earnings, they're forecast to rise from $4.8 billion this year up to $6.1 billion by 2026-27. What confirms this recovery trend is real?
I think the key indicator to watch is the price of spodumene concentrate. That's the semi-processed lithium material. That price saw, well, nearly a 70% recovery. It rose from just over US $600 a ton back in June to around US $1,000 by late August.
Right.
And this recovery, it isn't just organic demand growth. It seems to be a result of some strategic discipline from producers as well. Strong, ongoing demand growth, driven by EV adoption, particularly in China, and also large-scale battery energy storage system deployment, the BSS systems. That demand is finally starting to balance out with the production curtailments we saw earlier. The market oversupply seems to be easing, which should support pricing going forward.
Okay, so bringing it all together, what does this deep dive really mean for you as you track these global commodity markets? I think the core lesson here is pretty definitive. That minimal overall decline in resource earnings, that 5% figure we started with, it really obscures an immense, probably irreversible structural shift, and one that seems to have accelerated far faster than maybe many expected. The market is aggressively reallocating capital towards these transition metals, gold, copper, lithium, and away from the traditional, often oil-linked energy exports like LNG and coal. The global energy transition and that policy divergence between nations, they are now clearly the dominant forces shaping Australia's trade portfolio.
Absolutely. And maybe for a final provocative thought for you to consider, Look beyond just the core critical metals themselves. Start examining the emerging battleground of processing and refining. The energy transition is creating these new opportunities for highly specialized inputs. Consider, for instance, the industrial potential within the aluminum sector. Australia is likely to benefit from new research agreements, like the one Alcoa has with Japanese partners, focused specifically on extracting gallium from bauxite residue. Now, gallium is a key semiconductor material, and China currently controls something like 98% of the global supply. So this really highlights that the next critical resources battle isn't just about mining the raw deposits anymore. It's increasingly about controlling the innovative, often high-tech processes needed to refine these trace elements for advanced manufacturing supply chains. That's where the next wave of value might be created.